Hello, welcome to the Market Carver. I'm Adam Harter, Chief Investment Officer of Financial Enhancement Group. So thankful you took the time to click and watch this video where we'll go over a few of the things that we talked about in this week's investment allocation meeting. We're going to talk about funds exposure to China, something that's been a really choppy region here as of late. We'll talk about Libor, kind of a boring topic, but a game changer in terms of a lot of financial contracts, record inflows into equities, and then the S&P 500, a review and update of its technical status. But first, we're going to start in China. You go back to 2016 in this chart, and what it's showing you is the collective exposure of global equity funds to China and Hong Kong. Just for some context here, together China and Hong Kong should represent somewhere around 15% of the total size. All right, so if you were just to take all companies and weight them according to their size, 15% would be the exposure to Chinese and Hong Kong stocks. Meanwhile, though, if you go back to 2016, they only represented about 3.5% of those companies or of those funds' exposure to Chinese equities. A reason for that is it's very difficult to buy, traditionally has been very difficult to buy Chinese stocks. A lot of them could only be traded through those that traded on the Hong Kong exchange, but that has been a liberating area to invest in. And the MSCI indices, the group that puts together the EFA, which is the largest, they put together a lot of indices that we track or that ETFs track, and they were to gradually increase the amount that is represented in China. So they had been basically no component. These are mainland Chinese stocks. You weren't a part of an index. They were gradually going to raise up to their weighting where they should be around 15%. So they were going at a clip at about 1% a year. So as a result, equity funds is a very popular trade. It's one we did a time or two, which is to increase and get ahead and purchase these shares as they're going to be a growing piece of global funds. But as you can see, that has been unraveling rapidly here. They got up to be over 5%, but they are now back almost to where they started in 2016. So sentiment has just turned awful in China, and for good reason. The regulatory environment over there and the government crackdown on stocks and changing the game in terms of what those companies are going to be allowed to do. Very frightening environment to be invested in. However, when the sentiment gets this rough, of course, there's going to be pieces to pick up, especially if you can be in an environment where you've got somebody on the ground that knows where to invest. It's not something we're looking at today, but when you see this much sell-off of such a large group of companies, there could be opportunity to pick up from that. So Libor, which stands for the London Interbank Offering Rate. So this is simply a futures market where banks lend to each other at various time frames, whether it's 1 month, 3 month, or 1 year. Back in 2008 or 9, somewhere in that time frame, Libor had quite the scandal with several banks actually fixing the auction where those rates were set. So chances are if you had an adjustable rate mortgage or if you've borrowed on behalf of your corporation or other types of contracts, your rate was often tied towards Libor, which would float up and down. But because of that scandal, it was slated to be phased out. It has taken a long time, but it finally appears that we will be near what's supposed to be the end of this year. It'll be replaced by SOFR, the Secured Overnight Financing Rate. I can't pretend to tell you a whole lot of the logistics and what exactly is different, how they set, but do know that if you have any sort of these rates, that should be the term that you see, SOFR. It's still the same essence and spirit, where they are short-term rates that can go up or down and be adjustable. So expect at the end of this year, that term Libor to be saved and reserved for the history books. Record equity inflows. So if you turn on the news, of course, we just see nothing but bad all around us. Sometimes it's just seemed like the world has been on fire for a couple of years. But meanwhile, money has just been flowing into equities all year long, setting at least records by a long shot. 2017 was a pretty positive year. You could see a lot of recent years here. This goes back to 2010, I believe. These were years that were dominated by funds flowing into bonds. That was the more popular investment. A lot of it had to do with pension funds who need bonds to match their liabilities. But 2017 was a strong equity year. It drew a lot of money into stocks, and 2021 has just been absolutely blowing the doors off. So, of course, we begin to go the other way, and when sentiment gets this strong, we have to at least be cautious. When everybody and their brother has been chasing the investment, it's time to at least be a little bit cautious. That alone is not anything to be a trading signal, but the sentiment has been really strong towards U.S. equities, as evidenced by those fund flows. So it's been a good thing. Stocks have been going up, but at some point in time, the sentiment can just get a little overheated. Lastly, here we're going to go over the S&P 500 and the updated technicals. A lot going on this chart. I'll try to simplify it. First, if you just start with the green and yellow line, those are what is known as moving averages, both the 200 and the 50-day. So just take a trailing average of the prior 50, maybe the most popular technical analysis tool. But what you can see is really the theme of these last several months taking hold, and that is every time the S&P 500 has had a dip, and we've not had anything, at least at the time of recording this, anything near a 3% pullback, which is really extraordinary. 5% drawdowns, 10% corrections, especially in the summertime, very normal. Having 3% be the worst, very abnormal. But you can see what's happening here. Every time the S&P 500 gets down to that yellow line, which is the 50-day moving average, buyers have stepped in. Think back to all those equity inflows we just saw. A lot of those are coming in as we approach the 50-day moving average. So through this point, that is really a key trend. As long as that holds, a lot of our optimism can be maintained in stocks. If that breaks down, that's where we gain some additional technical concerns, where it's really been the strongest leg of our analytics. So there's been some fundamental concerns. There's clearly a lot of other things newsworthy that would compel us otherwise to be on the sidelines. But you put all that by the wayside, what have stocks been doing? They have been rising, and money has been flooding in. And so you have to at least give that its due respect, and we have via our risk barometer. This falling back and going below its 50-day wouldn't be enough to change our risk barometer defense, but it would start working it that way. So thanks again for giving us a few minutes of your time. Don't forget you can get more via Consider This program, which you can catch on several radio opportunities or through a more convenient podcast, however you choose to get yours. Thanks again. I hope you have a great weekend.